of course, is the standard setup for the 14-day free trial at PowerOptions. Those of you that are maybe just getting started, I encourage you to take advantage of the 4 steps that are here to help you start getting familiar with the tools and, of course, navigation of the site. There's the quick start guide. There's a variety of free flash tutorials. You can access our archived webinars underneath the Home tab here under free webinars. Let me just get that there. Yeah, so right there under free webinars. And the free webinars section, of course, there's 4 different categories of recent webinars: the PowerOptions tools, options strategies, options concepts, and of course requested topics as well. That's where most of our Friday discussions are archived. So you can actually access this. It's a public page, powerop.com/webinars.asp. I'm just going to send that to everyone there so you can take a look at that. Now, one of our regulars, Sam, sent me an email right before our presentation. He did really ask a question. Oh, that is, oof, that is devastating. But he was talking about how he had good success with deep out of the money bull puts on Roku and currently had managed some, I believe, with buying long puts. I think he said he had 3 or 4 long puts open on this position as well. I think he had changed his bull puts into long put positions and is making a killing now as this goes up. Big move in Roku, of course, he said, from last week. Last 2 days, tremendous upside profits for those put holdings as well. And of course, if also some iron condors he's mentioning there. One other thing I wanted to mention, we posted a third of the archived recording from Friday on Tuesday, and we posted the other 2/3 this morning, but there was an issue with loading them to YouTube, so they didn't really get posted until the afternoon. But it was funny because we were talking about bull put spreads in one of those sections, and we, of course, had looked at Overstock last week as one of the 2 bull puts that came up on a search that we created. All right, I forgot the symbol. I apologize. Let me just do the lookup here. It's OVSTK, I think. Yeah. OSTK. Yeah, there we go. Okay, but in any case, in that same vein, let's just go 10 days and hourly. Sorry. During our discussion last week, when we pulled up that bull put spread, and I said that, you know, looking at sort of I probably want to go 1 month, but looking at the chart for Overstock after we found it in the bull put spread, the question had come in about looking for a 30-cent net credit on a dollar strike difference with a 70% probability above. And we found the 2 stocks, and Overstock that we looked at had been doing this pattern, of course. And before that, it had kind of gone down and then up and then down, and then it did this and it came up. And I said I wouldn't make this trade on Overstock. It was roughly a 24.50 strike, I think, to a 23.50, or maybe it was a 21.50 to a 20.50. But I said, just looking at the chart, I wouldn't have done Overstock as a bull put credit spread. And I hope everyone listened to me, because it was just from Friday on, it was just a terrible choice. And that wasn't even related to earnings, I believe. It was related to something else as well. So that had a pretty big move as well, just like Roku did, as Sam had mentioned. But he had gotten his positions where he wanted to. Okay. Chuck, I see you've got a question for us here. I'm just going to go down here real quick. Good. Okay. All right. So Chuck says, Mike, let's just go back to the main home tab, ladies and gentlemen. Chuck says, Mike, I am a new user. End of day data. Okay, so you're subscribed to the end of day data. Absolutely love the software. Just closed. I have to open this up a little bit more, Chuck. I apologize. Hold on 1 second. There we go. Fantastic. Okay, just closed 18 profitable, is that 18 or 16? 18 profitable positions out of 18. Well, fantastic, Chuck. That's great. Curious to know what kind of strategy you were using there for the positions. I don't know if you were using the spread positions or if you were using iron condors. I would love to know what you were using, Chuck, there. If you were using our defaults for the screens that you were using in your strategy, if you've got your own structure there as well. also. So that would be interesting to hear. But congratulations on your profits there, 18 out of 18 positions in the recent times. Let's see here. Sam, you had mentioned about your iron condors on SPY as well. And we had talked about that a little bit last week. We had looked at some of the iron condor structures for SPY. We had discussed the dangers of skewing them one direction or the other based if you were bullish or bearish. We talked about the probability as well on the iron condors. And SPY seemed to have a nice trend over the past 5 days, 6 days since our last discussion. That's not where I wanted to go. And some of the other ones is he had mentioned I'm in a Dell position. I watched it go up 1% one day, 1% the next day, and then it continued to drop down as well. It just lost another percent today, roughly, or almost 2% today, as a matter of fact. And it's been a strange one, absolutely. VIX is still holding on as well. All right. Question comes in from Kevin. Kevin wants to know, what is the best way to find naked put positions? Should I use the sample searches or the picks of the day? Okay. Now, as I mentioned, we support 23 of the most commonly used strategies here in PowerOptions. I've got a few of them up here: covered calls, naked puts, the married puts, and more. We'll take a look at the naked put tab. And in every strategy, you have the search tool. This is the tool that allows you to put in specific criteria to identify trades that you want to see. But in every search, there are default settings. They're not direct recommendations or suggestions. The default settings you see in every search, the ones marked here by the double asterisks, are where Ernie, myself, and other PowerOptions users or PowerOptions staff members would start if we were entering a trade. If I was opening a monthly naked put, I might start out with the monthly picks of the day. If you wanted more safety, you might go with the tip sheet. And if you wanted to look at weeklies, the weekly picks of the day is a good starting point. These are the defaults that are shown in our quick view if you just clicked on weekly picks of the day. What you see here is just the top 2 or 3 naked puts, and it's also available for covered calls and will be available in bull put spreads. But it's just the top 2 or 3 positions that match criteria that Ernie had tested to maximize performance over long time horizons. Okay? You can always see the full information of what was done and how the backtesting results were done, and the results as well right underneath of it. But you might think that PG&E is maybe a little bit too volatile for your taste. It's great naked yield return for a 7-day trade. Yeti Holdings is too. But if you're thinking that you want to see more stocks, not just the top 2, well, then you could just go to the searches we were just looking at. We could take a look at that weekly picks of the day, because here in the search, Kevin, it shows us all of the results that match the criteria, not just the top 2. Still some good 7-day returns in here. Now, am I saying that you need to change anything? Well, we're looking for good average stock volume positions, stocks that have a positive earnings per share growth, no earnings between now and expiration, and stocks trading in an uptrend, as well as going a good range out of the money for a 7-day trade, good naked yield, minimum option bid price, as well as others. But if there's something in the fundamentals or the technicals that you would want to add to limit out some of the results, let's say you just wanted to only look for mid to large cap stocks, and we see here what we'd want to do is put in a filter of maybe 2,000 or greater. So let's put in a market cap of 2,500. And we have 55 total results right now. Let's just see if this changes anything. Nope, it only took out 1. And you've still got some familiar stocks in here: Apache, First Solar, BBBY, Halliburton is in there as well, Western Digital. And you can continue to make adjustments off of this search to sort of create your own, to use this as a stepping stone to create your own search. That's what I would do. All that being said, the sample searches are similar. These are simply theme searches that we've put together in every strategy for you as well. A little bit variation. This is more of a safety list, the broker and advisor recommended. You're not going to see as high returns as we just saw on a 7-day trade with the weekly picks of the day screen. because we're looking for stocks in the S&P 5-star list that have a larger market cap. Well, we are looking for at least a 1.5% yield, but this is actually going further out in time. This is what I would consider more of a monthly screen. You see here we're going 28 and 21 days out in time as opposed to the weekly. But it's looking for more stable, safer stocks that have good broker recommendations, part of the S&P 5-star list, but still offering a good yield. But again, that's for a 21 or 28-day trade as opposed to a 7-day trade as well. So that's something that you want to consider there, Kevin, in that case. My preference is to always use the main search in any strategy as a starting point. Let's just say I go to Bull Put credit spread again, and let's just open up the search. You may have a preference if you want to look for shorter term weekly spreads, or if you want to look for longer term spreads, month out or 2 months out in time. Now, yes, I've got some default saved searches here because this is the webinar account as well. And but you see here the 2 monthly searches, Bull Put number 1 and initial values, the default search to help you get started, and then the weekly Bull Put default screen as well. So depending if you wanted to go farther out in time with a spread position, which will allow you to go further out of the money, a little bit more safety and still get a good premium, but you're in the position for maybe 25 to 30 days. Or if you wanted to look for the weeklies, 10 to 14 days out in time, you just click on the default that matches your specific time frame. And then, of course, you can just adjust the criteria on the fly to match your needs and your safety requirements. Okay, so that's how I would go. I always prefer to start off in the search. Not a bad idea to scan through the sample searches, but I particularly always like to start off with a search and make adjustments as necessary. And of course, as always, Kevin, if you get stuck, you're not sure what criteria to use, you're maybe confused about some of the terminology of the criteria, that's perfectly fine. You can call or email us anytime during market hours, as you know, or just click on that free coaching button there underneath the home tab, and you can pick a time, an hour time slot. The coaching session is essentially a 35 to 45-minute conversation with myself or Ernie, walk you through the tools on the site and answer any questions that you have. Okay. All right, let's see here. I'm going to have to crease the size once more. I wish they would personally do this, and they don't. Let's see here. Okay, I'm sorry. Sam here said that first you had a bull put on SPY, reversed from 301 to sell the 303, 305 call. Oh, shoot. Sorry, folks, the question pod. Someone just sent in a question or a comment, and it was referencing an account. It just accidentally got deleted. And so in that case, there was a question that came in. It accidentally got clicked as trash because I was trying to remove Kevin's question and it clicked on yours. So there was a question that just came in a few moments ago. The last few words were on your account, I believe. So if you could resend that question in, I'd appreciate it. I do apologize for that. Okay, so... Oh, here we go. Sorry. Oh, Edward asks, can you send the information for the other saved searches you have on your account? Edward, what I meant by that is let's go back to Bull Put. This isn't my account that we're viewing. I have logged into it during some of the webinars. This is our webinar account. Looks like a standard 14-day free trial. Name it William Adama, of course. I was a Battlestar Galactica fan. So this is William Adama's account. It's our webinar account. These mass searches that you see here, all these other save searches, and that's a key point I forgot to mention, you can save as many searches as you want. Why would someone want to save multiple searches? Another reason, like I said, I may have a search in my Bull Put credits looking for weekly options. Well, I do, and you all have access to it. It's the weekly Bull Put search. That's what I use to open my Bull Puts. But then I might have something that's a 30-day out spread just looking at ETFs, looking 20 to 25 days out for ETFs. Conservative settings for June 19th. And you know what these are here that you're seeing, Edward, these are search criteria that were created during these webinars. A customer calls in, or one of the online attendees, as you're doing right now, would ask, well, can I look for bull put credit spreads with a certain MACD? Can we see how bull put credit spreads would have performed over the last 20 days just doing indexes and ETFs? Let's see, indexes on weekly spreads was one. One symbol at a time was a different one. Testing bull put criteria from June 3rd, a customer asked a specific question about looking at a higher volatility above 0.75 or 75% on bull puts and how that would have performed versus the weekly bull puts or the same time frame. I think that was from an open discussion on June 3rd. And so some of those other save settings you saw in the naked put screen or in the bull put credit, they're just done on the fly during these presentations. There's not much subtle difference. High IV naked puts. This one says Mike's weekly puts. That wasn't actually me. That was from a year ago. An attendee on the webinar named Mike K, I believe, asked a question about setting up a search to look on Thursday for naked puts that expire on Friday. This one here, yeah, this was during a webinar I created. So essentially, Edward, the criteria that I would use for opening a bull put, a bear call, of course a married put, a covered call, they're already there. I wouldn't make much changes to the default screens that I would use, whether I want to go weekly or monthly. I do make some tweaks to the long collar, but every time I find something that works better in a strategy for me personally, I usually update the default searches here. Ernie does it a lot more than I do. But if the market does change drastically, things in the market change drastically, Edward, we will make changes to the default searches to match the current market, but they're likely going to be subtle. Okay? All right, so that being said, Edward, if you have any specific questions about any of the default searches, well, I'm not hiding anything from you. If I come up with a good search and a strategy, I'll go over it with Ernie. We'll do some back testing on it, and if we find it's working better than the existing ones, we might change it or add it to the list. A lot of the stuff you're seeing there, as I mentioned, are just things that were created during webinars for other attendees and other options investors, just to show the functionality of the tools, as well as what might be possible in a comparison one direction or the other. Okay. Yeah, there's about 2 or 3 default searches in the search tool listed for each particular strategy as well. Okay, so Jerry, let's see. Jerry, I don't remember if you were talking about bull puts or iron condors, but I did remove iron condors last week, so I'm going to put them back in for the time being. Last week, we got on a discussion about setting... Oh, I'm sorry, this isn't Jerry. I apologize. This is not Jerry. I'm sorry. Okay. All right, this is Bob, I believe. And Bob was asking a question about the probabilities in relation to iron condors and comparisons here. So give me a moment on this one. Bob just did a copy and paste from a book, one of the 3 books that we have written. He says, a follow-up to my question last week on probability. From Ernie's book, Iron Condors, it is stated for, let's see, sorry, this is not your fault, Bob. This is the part of how this question pod works. I stated, for stock options where the price of the underlying equity is close to the strike price of the option at the money. Okay, when the underlying equity is close to the strike price of the option, the probability calculations based on the Black-Scholes models are fairly accurate. Right. However, for stock options where the price of the underlying equity is significantly different from the strike price of the option, the theoretical probability calculations developed using the Black-Scholes are somewhat less than accurate. This is due to the difference in the Gaussian versus the log normal distribution. Okay. What is the relationship to the expiration period? I believe is Bob's question. In other words, does this apply the same if you have 7 days to expiration versus 30 days versus 60 days, etc.? If open a credit spread or iron condor on SPX, for example, will this factor impact each expiration period in the same manner and to the same degree? I'm going to say no. Okay? And here's why. It is a known fact was the known studies that just like you had mentioned with the Gaussian distribution, I'm sorry, the Gaussian versus the log normal distribution, the further out in time you go, the equation is still supposed to work theoretically. Okay, the probability equation is supposed to work theoretically. But just like anything else, it loses quality. So even the delta calculation. Now you can say that, oh, well, I have an option that's 220 days out in time, March series. And let me do it this way. I was just doing this for the Bull Put credit spread product that was going to be is going to be posted soon. I'm sorry, it's going to be available for purchase soon. Bull Put credit spreads here. I'm going to take all expirations, and we're not going to use probability in this search, Bob, and we're not going to use delta. I'm going to use a range out of the money of, am I an iron condor? Yeah, short call. We're going to go 5 to 8% out of the money on the short call, and 5 to 8 on the short put. This is for an iron condor, where we have a bull put credit spread on one side and a bear call. Now, I want to use bull put. I apologize, Bob. I do want to use bull put. I just want to look at one leg. I don't want to bother with the probability between it, but then we can come back to it as well. So let's go back to bull put. I'm going to set up the same search. We're going to isolate one stock. We're going to try to isolate one single strike price and the same long price, although the weeklies get a little touchy in that case. But we're going to try it. All right, so we're going to clear out the settings again. Set my strike difference equal to 5. We're going to restrict that a little bit more. We're going to go 5 to 7% out of the money for the short option. Not going to worry about probability, but I am going to put in some basics for open interest. I want to see some liquidity. No. Yeah, greater than 0 is fine. And I'm going to leave it at all expirations. It has to have an option bid of greater than 0. This is just some minor stuff. And I'm going to target this with a 5-point spread. Net credit is irrelevant at this point. And let's just go to fundamentals. We'll do Netflix. Now, I may have to go in and customize my criteria there as well. Perfect, it worked. But I don't want to sort by return. I'm gonna change the sorting here. There it is. I want to sort by annualized percent return, highest to lowest. So naturally, that's going to give us the shorter term. Interesting little glitch there. Due to the bid-ask spread, it looks like some of these, the October ones are higher. Let me just sort by expiration date. Didn't think that would happen. All right. Now, I got to adjust my columns here for your needs. Okay, so I've got the break even. That's not important. Probability I've got. Short option delta I have as well. And actually, I think that sort of covers. Range out of the money we all know is the same. The volatilities are a little bit different. Okay, where I'm going with all of this is that you see here what ends up happening is this is for bull put spreads. All of them are selling the 255 and buying the 250 on Netflix, which is currently at 270.75. Same strike, everything from next week's expiration to 2 weeks out, 3 weeks out, up to 182 days out in time for the March expiration series. Okay, so when we look at the probability field, it's not to say that it's not accurate, Bob. Okay, so going out to March with the same strikes on Netflix, the probability above 255 is only 58.4. Well, that's because there's so much time and so much could happen that probability sort of bell curve equation starts to get skewed. It starts to get lower and lower because so much can happen in that time frame. Yes, naturally our targets would be up here, 82, 74% probability, looking for a 17% return. I prefer to be 14 days out, by the way, looking at an 85, 83% probability with hopefully a 15% return, maybe with some different strikes. Okay? But you see here, this is the same strike across time, and it's talking about the short put, the sold put, the pivot option, It's skewed this direction. Now, what also happens because of that is the delta is going to be skewed for that equation as well, because there's so much time. As we go this far out in time, the delta is almost double. If you see a 1-point movement in the stock price, 1-point movement down, we'd expect the March put to gain about 35 cents. We'd only expect this one here to maybe gain 15, 16 cents or so. But you see the increase drastically going forward with that as well. So you're asking about the accuracy of this. And it's a tough question to answer, in my opinion, because I haven't done studies where I'd say, well, did 58% of the time, is it true that 58% of the time, options that are 182 days out in time, let's say take a batch of 1,000 different strike prices that were, 5-6% out of the money at the time on a stock with a certain criteria, that 58% of the time the stocks ended over that after the 182 days, or that they ended below it. I don't really look at that because the probability mainly relates to what you're doing shorter term. You shouldn't pay attention to the probability, in my opinion, that far out in time, because it's going to be so skewed that they're all going to be closer to a 40 to 60% range. Okay, a lot of the options are going to be in that 40 to 60% range, because just like anything else, the longer time horizon you give it, the flatter sort of the curves go, the less skewed it becomes, I should say. So I can't tell you if it's accurate. Is it accurate that it matches the equation? Yes. The same equation that's used to look for the probability of shorter term options. The mathematical number is correct, but I can't give you an idea of how correct it is over that time. Can we say that options that are 7%, 6% out of the money, 62% of the time will stay out of the money 91 days away? Well, what are we in right now, Jerry? Or sorry, Bob. I apologize, Bob. What are we in right now, Bob? We're in a headline-driven market. Anything that shows a reasonable probability based over, even though it's including some of those dips, the past trading range of the stock, we could all throw out the window a month from now, depending on what happens, positive or negative. That's the key to remember, is that although we use probability for shorter terms, the thought underlying that, okay, the thought underlying the idea of probability is that I'm basing the probability on the fact that, well, the equation is basing the probability on the fact that if things continue as they have over the past 50, 100 days, the time frame that's being used, if your expectation is that the market and those stocks will continue that same pattern, and it does, these are going to be very accurate. Not saying so much about these that are more than 60 days out in time. Okay, but the shorter term ones are going to be very accurate. Now, you've got someone talking about new tariffs. You've got someone shooting rockets into the Pacific. You've got a fleet of drones attacking an oil field. That's something that didn't happen in the previous trading range and is going to affect the probability and affect what happens. We talked a little bit last week about how certain things of that nature, they can't be seen in a stock chart. And they can't be seen in technical analysis. Sam brought up a point last week that he felt that, if we hit new highs on SPY on Monday or Tuesday, we start hitting those new highs again, then there's likely going to be a pullback. And as we saw, there were some ups and downs this week in different things. A lot of the probabilities were still the same. Let's just take a gauge here, Bob. Let me just, let's do something really strange. Let's clear the filters. Let's look weeklies. I'm sorry. Let's go to weeklies. Let's go 2 to 8 days out in time, for example. Small net credit, return of 1. And I'm going to go probability of 90. Okay. Yeah, I'd want some stock purchase. What am I doing here? I'm creating a high probability search with at least some return, which might have been too high. I don't care about the stock price range, but I do want a stock in an uptrend. That's all I'm going to do. We're even going to avoid earnings between now and expiration. Now, What am I going to do with this? I'm just curious. So we just created a basic search, 90% probability, weekly options. It's dominated by indexes. Let's take that out. I'm going to remove from the list field indexes and ETFs. There we go. All of them. Just take them all out. Let's just look for some straight stocks. One last thing I should probably do is add in a filter for one security. Yeah, so I'm not dominated by one. Let's see if we can do that. One result per security. Not going to worry about strike difference, but if I see a lot of one strikes in, okay. All right, so let's change this up here. Greater than or equal to 2. Open interest greater than 10. Volume greater than 5. Just more liquidity there. Range out of the money, let's put it at 3%. Let's get this down to about 60 results, and then I'll use that filter. And I see your other comment there, Chuck. I'm going to be right there. 170, that's good. Now I'm going to use the one result per security. All right. So we've got Boeing, we've got Biogen, we've got Caterpillar, all bull put spreads, 90% probability. Yeah, small net credits, strike difference wide, so we've got a variation of just 2 or 3% returns, some 11s. Let me save this just as high probability test, okay? And this is just for fun. So we're going to save that search. We're going to look at the high probability test. Now we're going to go back to our back testing tools. And we're going to go to the Smart History Excel, which works just like the search. We're going to look for bull put credit spreads from September 13th, last Friday, that matched our new high probability test. So what do we know about these? Well, we know that any results that come up here on the search from September 13th that we just created, and this is not a recommendation of what to search for, ladies and gentlemen. This is more of taking a look at the top 10 or 15 results, sorted by return, not probability, but the top 15 results or so that had that high 90% probability, and we're going to see if we're 90% right. Of course, no positions were found. That figures. That can't be the fault there. It's very interesting. We've had a lot of results today that match that criteria. We didn't have anything last September 13th that matched that criteria. That's why I'm wondering if the days somehow got fouled, but I don't think that would be the case. Shouldn't be reading it as 8 days out in time. Yeah, okay. Let's just change this. Anyway, I'm not going to spend too much time on this, but this is just a basic search we're looking at, Bob, just to try to see if we're right. And a lot of times I do this. When all my back testing I've been doing on the bull put spreads, when I'm looking for an 85% probability or higher, I typically do end up with that higher probability of 83, 84% success rate as well. Okay, September 13th. Let's see if we find, real quick, let's just see if we find any on September 6th, last Friday. No, the Friday before. Yeah, let's just see if there's anything there. Not saying that there is, but let's just take a look. All right, so we'll just try this one more time. But in general, that's what you typically see. However, if I did this weeks and weeks ago, and that first August 5th, if I had run a search for August 1st with things that had a 90% probability, and then that 600-point drop hit on, I believe, August 5th, August 6th, it wouldn't have had a 90% success rate because that's an outside force. Had it not happened, you probably would have seen 88, 89, 90, 91% success rate on those trades as the market was continuing the trend before that 600-point drop. Okay. So we'll take a look at that later, see what we can get. But yes, the results get skewed as you go further out in time. The Black-Scholes pricing model is not as accurate because so much can happen over those time frames. However, I feel they are fairly accurate on the shorter time frames, under 20 days, under 25 days, in that range. Okay, great. So Chuck is coming back to us now. He says, in 40 years of trading options, wow, so he's got about 3 times the amount of time I've traded options, actually. Yeah, I'm about at that. Actually, I'm closer to 17 years. So yeah, but you're still way up on me. That's great. 40 years of trading options. This is Chuck. I have never bought calls or puts. I have mostly done credit spreads and iron condors. After signing up for PowerOptions, I decided to try something different. I ran your default calls and put scans and came up with a large list for each. Then looked at each call, okay, for, oh, hold on, sorry. There we go. Default calls and put scans and came up with a large list for each. I then looked up each call, for instance, on the Vantage Point software. Vantage Point was suggesting a short move up. I bought the call. I did the opposite for the puts. Good. I bought 9 calls and 9 puts on Monday, 50% profit targets on all 18. A few targets were reached each day, with the last position being closed just before the market closed today. Oh, fantastic. So that's great. That's how you were doing it. You're taking the general search and using another form of supportive analysis, and you had 100 winners. That's great. 100% winners, 18 trades, both long calls and long puts. That is very interesting, Chuck. That's great. I'm going to have to take a look at that. Yeah, okay. Yeah, we saw the big tech there as well. Okay, so let's go back up here. Let's see here. So Robert had a couple of other comments there. Sam's Gold, Cat and BA as well. Okay, there we go. All right, so Bob's first comment there is a general conclusion, although hard to answer, is that an iron condor with a 7 DTE using a 90% probability for both sides. So what he means is an iron condor structure, a bull put on one and a bear call on the other, and using a 90% probability OTM for both sides. So the bull put has to be 90% probability above the short put for the stock. I'm sorry, for the strikes, we want a 90% probability above the short put and a 90% probability below on the short call. And he's used a 7 DTE. For both sides, should be somewhat more reliable than an iron condor with 45 days to expiration and the same 90% probability. Yes, I would say so. Absolutely. So what he's saying is that a shorter term iron condor with a 90% probability 7 days out when selling should be somewhat more reliable than an iron condor with 45 days to expiration, which will give you a higher net credit, and you'll be able to go further out of the money, and you still have the 90% probability. And my general conclusion answer to that would be yes, just because especially we can just take a look at anything over any time horizon in the last 5 months, but we'll use SPY again. Whether you're thinking about trading SPY, SPX or not for your iron condors, or you're going to do something else, let's just go to a 6-month chart for SPY. And there you go. So here we kind of see this concept and idea that, you know, if I opened a trade here, 45 days would be out here. So in the first 7 days, you know, got a good probability. Even 7 days after that, got a good probability. And here, we might have even had 3 profits in a row. We did 1 weekly here, 1 weekly here, maybe 1 weekly here. We likely would have had profits. Now we would have started dipping them here. On the 45-day trade, you had almost 20 days of profit, but you might have only had a 30-40% profit, meaning you might have been, even though the market was going up at this point, and your 45-day out spread was here on the May series, because of time decay, you might not have gotten to a 50% profit. You might not have gotten to a 40% profit, depending. So then it starts to drop, and now you're getting in trouble. Now you're getting in trouble. And the likelihood is for that 90% probability 45 days out, you're probably here. And at the end, you might have ended up taking a loss on this position. Okay, so you open a position here if you think you've got the bottom. Well, 45 days out, you're looking great. And then you open another position here and not so great. But it doesn't matter because you might have had a 1 weekly winning position here, shorter term, with a 90% probability. But then this is what we were just talking about, the 600-point drop. So anything you were doing bullish, in this case, would have gotten hurt. The bull side of the iron condor, bull put credit spread. And then you start to get up here. And then we pull back down again, and then we're going back up this way as well. But you see those 1% days we were talking about for the different trades there. So yes, when you just look over the course of one of the broad market indicators over the last year or so, if you look at every 45 days, you could easily say, well, the probability for this time frame likely would have been at 90 if I was at X strike or Y strike, and then you can see 45 days later, at some point it broke through it because of this headline-driven news cycle that we have to be in. So it's, again, one of the reasons why we always advocate that you shouldn't be doing more than 15% or 20% of your total portfolio in spread trades, probably closer to 10 to 15 as well. Okay, and he said that's general concepts of option reality. Yep, absolutely. Okay, so let me see here. Sam says one could close the trade in 20 days to profit. Yes, but the trick is in some of those things that we were just looking at, as you mentioned, in the first 20, 25 days or so, everything was looking good. Or maybe it was more like around 18 to 20 days. But right after that 20 days, it started to fall. Like I said, you might have only had a 40% profit. Maybe you hit 50% profit on the credit you expected in that case, Sam. But if you don't close it at the right time, you can get hurt. And of course, you know, I opened bull put spreads. I'll be honest with you. I opened bull put spreads at the end of July that some of them got burned for the August 5th move. They were out to the second week of August at the end of July when I opened them. So I lost about 20% on the two I was in, and the third one ended up still closing for full profit. So I was happy with that. No, I'm sorry. One got closed for a 20% loss. 20% of the maximum loss. The difference in the strike price was around $2. The other two did still expire worthless and didn't get threatened, even with that August 5th move. Okay. All right, so we handled Kevin's questions. Bob's questions related to probability. We sort of tried to tackle in relation to, you can just see it when you look further out. You sort of get that flattening of the numbers where the deltas, you know, farther out in time at the same strike, you know, are going to be almost twice as much, and the probability skew is going to drop probably by 50% or so. So we saw that we had the 90% probabilities, and then we saw it come down to only 50% at the same strike, 56% at the same strike, versus the 7-day strike with the 95, 96% probability. And it's just, Sam comments on it again, just want to reiterate it to anyone who's doing the spread positions, anyone who's doing the iron condors, even Chuck, with the great success you had by using the search for what we look for, and then going against the list, going against the other analysis tool that you use, had that 100% success rate on long calls and long puts short term. That's great. Any leverage strategy, buying calls, buying puts, credit spreads, iron condors, things of that nature, any position that has a chance for 100% loss on a position that might, if a position moves only 5 or 6%. I think about a bull put spread a weekly. To get the return you want and the credit you want, you might only be 3 or 4% out of the money on a good stock. If that stock falls 5% in that 5-day period, you're looking at a 100% loss. I buy a slightly in the money, slightly out of the money call, and the stock drops 5%, I'm at 100% loss. So when we say, I bring this up because I always say that, you know, anything that carries a 100% risk, long calls, well, some people say that, well, covered calls have 100% risk. Naked puts have 100% risk. Well, you're right, if the stock goes to zero. I'm talking about any strategy that could have 100% loss with just a 5 or 6% movement in the stock price in this headline-driven news market. Any strategy such as that, the long calls, vertical spreads, even the debit spreads, position sizing is the most important factor. Yes, you want to have the right criteria. Yes, we try to force you into the right criteria with the probabilities and what we'd look for fundamentally and technically as well. But at the end of the day, if there's something you could lose 100% of your investment on with just a small move of 5 or 6% in one direction, that shouldn't probably be more than 10% of your total portfolio. 15% is a little bit aggressive. But that's about what I allocate to bull put spreads in my portfolio. And then the rest of it's in protected positions, like married puts, that can only lose 4 or 5%, or small quantities of diagonal calendar spreads. Okay. Let's see here. Let's see. Oh, sorry, that was Sam. Yeah, just reiterating that point there. Sam does comment is I do have large losses sometimes, but the trade he's got into on Roku will get you back into business. Yeah, I mean, I took, let me see here real quick. Do I have it up there? I don't think I do. Okay, I'll come back to that later if we wanted to, if we have to. Okay, so, oh, let me go back to this here. I'm just going to try something else. Let's see. So there's a lot of them that match. Oh, this is the high probability test. There's a lot that match this for next week, next expiration cycle. That's interesting. We didn't see any of the others too. I wonder if they're maybe the historical data hasn't updated for today, and that was causing a problem. I'm going to lower this. I really shouldn't, but I'm going to lower this down a little bit. Let's just go 1% out of the money with the 90% probability. I'm going to resave this. I'm wondering if that might have been part of the problem. I'm going to try to do one more back test, back a couple weeks. Let's actually do that. Let's go back to July. No, it's not a fair assessment. Yeah, let's go into the back test again. Bull put credit spread, select date. Let's go August 3rd again. That was the drop. And it started to come back. Yeah, so let's go to the... All right, I'll do it. I don't think this is going to work. Well, no, I won't. There we go. Let's go to Friday the 9th and look at that high probability test that we just changed. We didn't force it to go as far out of the money this time. I want to see if we get some results in there and see what we can find out also. All right, looks like we've got a different Chuck here with a question. And Chuck, I'm going to be very happy to answer that for you in just 1 second. It's probably actually going to be 10 seconds, Chuck. I'm just going to see if this comes up with any results from August 9th. My apologies. I think the headphones are set a little bit too tight. All right, so while I am waiting for that, right there, while I'm waiting for that back test to show if it gives us anything, I will handle Chuck's question right now. This is Chuck S., and Chuck S. says, what rate of return is realistic over time if I only want to use strategies that I won't lose money? Well, we don't want to lose money at all, but we know what happens. So I think what you're referring to is using protected strategies, such as married puts, that carry just a 3, 4, 5% risk, 6% risk on the position. You might lose money, but it's going to be very small. Or possibly even long collars with a stock structure where you can set the return to be 2, 2.5% with only carrying a risk of 3, 3.5%, maybe 4%. Okay? So with these strategies in mind, in a good, let's just take the married puts, for example. I open multiple positions over the course of the year. I'm taking a 6% risk. It's capital intensive. You need the capital to have the 6% risk of what you invested. Yes, I can get the same monetary risk, what looks like the same monetary risk with a long call or with a synthetic. But remember, I'm risking 100% of what I ever invest, of whatever I invest into those trades that aren't really parity trades to the married put position. This is carrying distinctively, let's say, a monetary risk of $5 or $3, but that would only be 5% of the underlying stock and my total investment into the married put. Where if I use a synthetic, I might be risking $3, but that's going to be 45 or 50% of what I've invested. I buy a long call for $3 at the same strike as my married put. I'm only risking the same $3 if I buy one contract, but that's 100%. Most people would buy 5 contracts, have 1,500 invested. Now we're not at a parity trade anymore. So in a strong market, I'd say 12 to 15% with this kind of structure, personally. And with a market like we've seen recently, I still think that maybe 9 to 10%, 9 to 11% is possible. In a down market, well, you might lose, but you might only lose 2 or 3% in the market. And you could make adjustments to profit in both directions with this structure and more. With the long collar, where you're essentially doing a covered call, but you're buying out of money put to hedge it, I would, and you take a positive premium, In a down market, you're going to lose. And you might lose more than what you're seeing here with the longer-term married puts. That's been my experience, personally. In an up market, you're going to be making less. You're still probably going to be making 7, 8, 10%. If you happen to be right 70% of the time with a standard collar, that might actually go up to 12 or 15% or more. Okay. Now, I really should do this. Sam commented a while ago, a couple of months ago, I believe that he was up about 60% on his portfolio that he was using to trade options with. Different things of straddles, strangles, and more. And he already admitted that, yes, he does have some big losses, but then when he gets a big return, he sort of gets back in business. As Chuck mentioned, the other Chuck had mentioned, he never really bought long calls and long puts, and then he started to do it with a second verification service that he uses, and he had a 100% success rate. He found the ones that went down for the puts, he found the ones that went up for the calls, and he did them a short term. In a bull put credit spread, it's kind of tricky because in the discussion I've been working on for the full product, and everything, all of my knowledge, what this full product is essentially all of my knowledge into bull put credit spreads over the last several years. Now, with a bull put credit spread, I mentioned that my target return average over the course of a year or over, let's say, 50 trades or 100 trades is about 15.1%. Seems like an odd target. The reason I'm using it is because that's the average using the criteria that we've set up. And you're probably going to be right about 83, 84% of the time. Not promising you're going to be right 100% of the time. And you still have to control the losers that move against you to 50%. Less than 50% if possible. Average is about 48.1% on the loser. So if it's a 2-point spread, I might only lose 90 cents. I'll manage it before I lose the full amount if possible. Okay, that's the idea. That's the scenario that I'm looking for. Now, what did I just mention 10 minutes ago? To be conservative with a strategy that can lose 100% with a simple 4, 5, or 6% movement in the stock, this shouldn't represent more than 10% of your total portfolio value. I'm aggressive, so I'm up to 15, okay? Now, the reason why I'm bringing this up, Chuck, is that last year, in 2018, where 6 of the 12 months were negative, trading the weekly bull puts had these exact numbers. 15% average on winners, 83% success rate, control the losses when there was a loss to 48%, only 17% of the time. Even including going all through December, this only made 9.9% on the total portfolio. It gave a profit, let's say, of $9,900 on a $100,000 account. That doesn't sound great for a leveraged spread position. But if I was in a $100,000 account, I would have only been allocating $10,000 to $15,000 to the spreads. So that $9,900 on an investment of $15,000, well, that's a pretty fair return, isn't it? But I wouldn't have done it with 50% of my portfolio because at one point this allocation, the $10,000, $12,000, or $15,000 I would have used, or I should say 10 or 15% I would have used of a $100,000 account into the spread positions, dropped down 42%. I think it dropped down 42% of that value at one point. And that was sort of after the February 5th through February 9th crash. Okay. So this might not look impressive. As a return, even with bull put credit spreads, it only made 9.9%. But that was of the total portfolio because we only took 10 or 15% out of it. It was a much higher return, even in 2018, on the money you had invested, but you didn't want to invest more than that 10 or 15% because there was wild swings, because 6 out of the 12 months were negative performance. Long story short, realistically, with any option strategy, we sort of target around a 10 to 15% return. That's really what we look for overall on investments. My portfolio is broken apart into about 3 or 4 strategies. Other investors do more. You've heard me mention his name a lot there, Chuck, but Sam has exceeded that or did exceed that in the first few months, but he was talking about the certain strategies he's using. and it's a combination of doing some 2 to 3 month out straddles or strangles, doing some selling in the shorter term to help lower the cost basis, and then rolling as necessary with, again, proper position sizing, so no one position that he's in could take his portfolio down by probably more than 4 or 5%. And that's the exact same structure I use for all the positions in my portfolio. I do married puts, diagonal spreads, some straddles and strangles around earnings, bull put credit spreads. But if there is a market shift, like there was mid-October of 2018, before we started that steep decline, I moved out of some of the bullish positions I was in, the credit spreads and the diagonal spreads, focused more on the married puts and just some straddles that were 2 to 3 months out in time, similar to what Sam does. But again, realistically, there are you know it, you can see it, you guys all see the advertisements, because I see them too. I keep an eye on my competitors, and there's always someone who's going to say, yeah, you can make 300,000, I'm sorry, 300. You can make 300%. We made 332% on Apple calls in 5 days. We made 285% return on DY calls in 6 days. And then you say, okay, that's great. And then you think about what the other Chuck had mentioned earlier. He opened 9 calls and 9 puts. You get an email from a service that says they've shown 600% returns in 5-day trades on stocks following this particular criteria. Yeah, they likely open 15 to 20 different positions in that cycle. They're not talking about the other 10, 12, or 15 positions. They're just talking about the 2 or 3 that showed that return. And with a long call, as we talked about, especially if you're buying weekly calls, if it doesn't go the direction you want, you could have that 100% loss, 90% loss on what you paid in that call very quickly, because that's how fast the time decay is going to move against you. That is my personal opinion. This was backed up. Ooh. Oh, I don't have the right ones in there, and I can't create one, can I? Oh, that's a shame. Let's just see. All right, I'm going to launch this real quick. Now, let me do something here. If this causes an error, ladies and gentlemen, it won't. Oh, no. Okay, hold on. I had this from another webinar, and I don't have the numbers here, Chuck. I really wish I did. Your screen should be paused right now, and let's see here. All right. Okay, just hold on. Let me 1 second here. Oh, I knew it. I knew it. I knew it. I knew it. So it's okay. There's a small crowd still here. Let's just do it this way. Everyone who wants to answer, and you don't have to answer this, of course, but everyone who wants to answer this, use the question pod to send this to us. Think about this this question here. I talked about how I said 10 to 15%. A few months ago, we did a different webinar, and we asked, yeah, not in today's market. Sam says not in today's market. Right, so the last 2 or 3 months might have been more difficult. I agree. That time frame I was talking, I'll show you actually, that time frame I was talking about for SPY for 2018. Let's just take a look and see if we can get the chart for 2018. Or maybe not. Okay, so here's the question I'm going to pose to you, everyone. Based on your trading, what you've seen, just use the question pod and write down a number. What is your yearly expected return on your investments for the portion of your portfolio that is using options? Okay, so what is your expected return rate? What do you expect to make? And let's break it down into sections. Are you expecting lower end, 0 to 5% return with the options portion of your portfolio? On the investment you actually put in, not your entire portfolio, but expecting 0 to 5%, 5 to 10%, 10 to 15%. That's sort of where my target is. 15 to 20%, and let's just call it 25% or higher, or 50% to higher. So just chime in. Use the question pod and just tell me. Are you expecting 0 to 5%, 5 to 10%, 15 to 20%, 25% or higher, or 50% or higher? What do you feel is your expected target for return on options positions in your portfolio? And there's no wrong answer. Okay, there's no wrong answer. Just because I mentioned 10 to 12% doesn't mean that you have to think that as well. Absolutely not. And you might not be making your targets, but what are your targets? Okay, we want to know kind of what your targets are. So just use the question pod and write in the number of what is your expected annual return for your options investments. And while you're doing that, I'm just going to try to plug this in here. And I might even do something else in a second too, okay? So, okay. Okay, so we've got some good answers here. Earl is 10 to 15. That's good, Earl. Earl's around where I am and my expectations. Bob's a little higher. Robert, you're at 15 to 20. That's great. Like I said, there's no wrong answer here. Sam is 20 to 30. He's pushing 20 to 30. So we're going to just put you, Sam, in the above 25. The Chuck who told us about his long call gains that he had, the 100%, he's pushing 50%. He's looking for the 50% annual return on what he's investing in his options. Yeah, Sam says he doesn't allow himself usually to go above 60 to 80% profit on a position. So on those long calls, if he gets a 50 or 55% return, he usually takes the profit and opens a new position. Okay. So there's about 25 people, I think, still in the room. I started to fade out here because we're past 5:30. We had 4 answers there. It was a mix. No one said lower range of 5 to 10%. We're always happy with a gain when we get it, aren't we, folks? But that's a different story. So Matthew says, I take what the options will give. Okay, so Matt probably has a specific, I should say Matthew has a specific strategy he's using, and he's probably targeting a certain percentage return. But yeah, he's going to look to make money, but he's not just like me. There are times when, hey, I want to make 10% overall on my married put position that expires in 150 days or in 6 months out in time. If it happens in 2 months, if it happens at 3 months, that's great. I want 10%. If it doesn't happen and I hold it longer, well, if I get 2% on 4 months or 2% on 5 months, it's still a win. So I'll take that in that case as well. So real quick, though, you know what I'm going to do next. I did have this one there. Who's doing it? All right. For what you said that you're targeting, is who's exceeding their goals, who's on par with your trading goals, who's profitable behind on their targets, who's at break even, and who is losing money. I'm middle. I'm going to be honest with everyone. I am middle. I am profitable, but I am behind my targets. My radioactive trades that are posted in Fusion are not exceeding my goals by any stretch of the imagination. They are behind. And since that's a larger portion of my portfolio, about 50% or so, I need to do some management quickly and then do some new positions the next 2 or 3 months. My screen is paused, but you guys should be seeing that. I want to find something here real quick. Just give me a second. What I was looking for on all the webinars that I have on my screens and everything along those lines is that result that we did when we ran this same poll. We had the numbers behind it. We asked the audience what their targets were, and then we asked, well, who's making what? Okay. All right. So let me see if I can find what I'm looking for here. If I can pull this up. Don't tell me I'm in the wrong section. I am in the wrong section. Okay, that's fine. All right, so let's go ahead and close the poll. I'm going to share the results with everyone. I need that other one while we're going over this. So 17% of you are exceeding your goals. Again, doesn't show me how the exact number of those of you that answered. That's perfectly fine. But what we have with those who did answer is that 17% are exceeding goals and 17% are on par. So 34% of you are making what you expected or exceeding your targets not related to what your targets even were. On the other hand, 33% are profitable but are behind the targets. That's where I am, to be honest. 0 are at break even, but 33% are losing money. So we have 66% that are behind their targets and losing money, and 34% that are on par or exceeding goals. Okay, and with this whipsaw market, with these things that have happened, that's what we should expect. I mean, it's very hard to see the same returns you'd want to see and expect to see in a consistent market with these consistent probabilities and more with those as well. Okay, but that's sometimes how it goes. This is what I wanted to show you very, very quickly, ladies and gentlemen. And this will help also with kind of the discussion that Robert and I had before as well. So let me go ahead and show my screen again. This is a different slide presentation. Which screen are you guys looking at right now? Oh, you're still looking at the poll, that's why. All right, so there's our poll. All right, now let me get to the right screen, folks. I'm on the right screen. Now, we've already talked about position sizing, proper position sizing, and what you can and cannot afford to lose. This was 2018. This is what I've been talking about. There's that February 5th through 9th move. There's the March 21st to April 5th. And a little hiccup here at the end of June. And then straight up through September. Then the October, try to have a little rally, and then boom. So 1, 2, how it started. If you look at it by the start of the month, the end, 3, 4. Not really 5. It was even. 6 and almost 7 really. So we could almost say 7 out of the 12 months. This one is tough too because the June one, it really started down here and it ended down here. So it's almost break even May and June. Everything else, this was up, but then these were all down. But 6 out of the 12 months and those events happened suddenly. Where am I going with all of this anyway? That it was tough to predict the probability number one because leading up to it, as we talked about earlier with Bob, everything was going great. And the probabilities, if I open positions here with an 80-85% probability, all the positions probably lost because of that February 5th to 9th crash. Here we started to recover. Any positions I opened here with a 90% probability probably lost. Whether I was going 7 days, 5 days, 14 days, or 45 days out in time, even with the 90% probability. That's what I was trying to illustrate with the search tools and the historical search. Here we would have been great. Positions we opened here probably would have been bad. Great through this whole cycle. I had a couple losses here. Stopped trading here. I didn't actually trade bull puts in this cycle because certain things on the SPX, SPY moved. Now, I'm just going to show you real quick. So all three, did have 3 positions open that I opened on January 26, 2018, Netflix, TXN, and GD. All probabilities were above 86%. And then that happens, as we all know, and this is what the portfolio looked like. So leading up to February 5th, from January 26th, everything was almost profitable. Not a 50% profit. We're talking a 10-15% profit of the net credit, of the max return we expected. Wouldn't have closed them then. And then February 5th happened. This 255, this was the short put strike. So in one day, Netflix was now below my short put strike. TXN was below both strike prices. GD was below both strike prices. So I closed these 2 positions out on the first day, and then I closed this one out. So I took a 63% loss. That's on the 2.5 point spread on GD. 63% of that 2.5 points. Or actually the maximum risk was, which was a little bit lower. 54% on the 2 point spread for TXN and 20% on Netflix. Netflix did go back to profit, but by that time, TXN was at a 95% loss at 102 with 2 days left to expiration. GD was at a 56.8% loss. And then if I'd waited till 2.8, there you go. That's an average of about a 70.2, 75, 71, 72% loss on average. And then 4 days later, every spread was at a 100% loss. So where I'm going with this is that although these were the 3 positions I had open at that time, and I took the losses of 20%, 63%, average of a 45.9% loss on what I was allocating to bull put spreads just on that day. Side note, this loss was countered by the 8 calls I had in the volatility index that I bought in January. So the major losses that were here, the monetary amount was countered by the huge gains in the VIX calls. We're talking small relative numbers here, not large contracts, not hundreds of thousands of dollars invested in the spreads at all. But the reason that I'm going through all of this is to show that even with this loss, because of that movement in that time period, on or about, following the same criteria we're talking about, the same 86% probability we were talking about, there we go. At this point, if I had a $100,000 account and I had allocated about $15,000, 15% of that to trade in spreads, following the criteria we use and the structures and the setups that we use, even though that $15,000 it was a loss of $6,885. Okay, if I had $15,000 into that 3 trades at this point. While we were here, the total portfolio value was at $125,000, $125,506 something. Okay, what does that mean? It means even when taking a 42, 43% loss in the portfolio here with this strategy, it still went up to increase this by 25%. By the way, that's not a 25%, that's a 25% gain on the total portfolio. It's a $25,000 gain of investing $15,000 into it. That's right on track for my targets that I look for bull put spreads. And then this happened. But still at the end of the year, this was up to 109.9 something something. Okay, it was up 9.9% if I had used $100,000 and allocated 15% to it. So that's still a reasonable return on the 15K. It's still a reasonable return on my portfolio, but it's not 50 to 60%. If this trend had continued, this probably would have gone up to 140, 135 over the last 3 months. The normal market continued, those 85% probability spreads would have continued. But if you kept trading all the way through this, you still would have had a profit. You would have been on target in October until that disaster happened. And it was still an 83% success rate for close to the 100 and 203 trades that would have been opened during the cycle. Is that right? It's a little lower than that. I'm sorry, I think it's about 91, 92 trades that would have been opened during this period. It was still an 83% success rate on the bull puts with the 85% probability screen, even though 6 out of the 12 markets were negative. Okay, so that's a sneak peek. That's something I just pulled up for you from Module 3, Section 1 of the Bull Put Credit Spread product, showing that the allocation is important and you have to decide what you can and cannot afford to lose on any strategy that you can lose 100% on if the market just falls 5 or 6%. That is the key in that case. Okay. As well as a discussion again for Bob about the expectations of probability. Had that continued, we still would have had a profit to our expectations for bull put spreads, but the last 3 months sort of fell apart and we didn't see that. Okay, I apologize, ladies and gentlemen. So let's go back here and here and there. Okay, so Sam says he's targeting, with what he's done so far, he's targeting around between 160 to 200% this year. So that'll be naturally fantastic. Yeah, and following all that goes hand in hand. Sam just said time stops are important. You want to make sure that you use your time stop as well. Absolutely, that should be part of your trading plan, is the stops, and to adhere to the stops. Don't overthink it, and don't, of course. Hard to do, but don't use the trader's philosophy of, oh, that was an unexpected twist. It dropped below my stop, but I'm not dropped below my mental stop, but I'm not going to close it because I think it's going to recover in the next 2 to 3 days. Keep your trading plan and adhere to your trading plan. Otherwise, you can get burned long term. Ladies and gentlemen, I don't see any other questions that have come in. So if you do have any last minute questions, we're at 5:49 p.m. Eastern Time. If you have any last minute questions, feel free to send them in. I do want to remind everyone, of course, that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. Options involve risk and may not be suitable for all investors. If you like some of the tools that you saw today, we focused on the search tool, the default search criteria for the different strategies, how to make adjustments to those criteria. We created a basic search from scratch to look for 90% probability bull put spreads. But you can have full access to all of those tools with the real-time quotes, I believe. Just go to powerop.com, put in your name and email address. No credit card, no billing information is required. We can't bill you if you don't decide to continue it. The trial just ends after 14 days. So it's a no risk, no cost, free trial, 14 days, name and email address, and you get started right away. After that, the subscription levels start at $45 per month, and we do offer different services. If you want to use end of day, as Chuck had mentioned earlier, he's on the end of day, very happy with the service, and had a great success rate with his long calls and long puts with his analysis in the last cycle. It's fantastic. The delayed service, 15 to 20-minute delayed data, is only $65 per month. We, of course, offer real-time and then the full package service as well. If you're looking for other free education, we talked about the webinars page. I sent everyone the link, powerop.com/webinars.asp, to go through those 4 categories. You can also check out our blog, blog.powerop.com, or you can also access us on YouTube. You've seen me post most of our open discussions there and send you the links in the email, sent you the links to the YouTube archive as well. Okay. And if you think of any other questions over the weekend, Sam did comment in. He said, I apologize, plan your trade to trade your plan. Options can be a great tool to lose big time. Plan your trade and trade your plan. Exactly. That's the idea there. Perfect. And I'm sorry, Chuck says, now you tell me there's a risk. I'm sorry, Chuck. Yeah, there's risk in everything, and that's unfortunate. And there are risks in the bull put spreads naturally. There are risks in the long calls, but the headline-driven market is just a way. We had a customer last week. I don't want to say customer, but we had a webinar attendee last week. I forgot the gentleman's name. I might have it written down right in front of me as I was editing today. Was it Greg? Yeah, I believe it was Greg. Greg had asked last week, is there such a thing as a no-risk trade? Well, he was looking at conversions and wasn't seeing the same value. The conversion, of course, is that straight line profit and loss chart, a collar structure of owning a stock, selling a call, buying a put with the same expiration date. And we looked at the reversals, the short conversions as well. And not every radioactive trade, every married put we do is going to be bulletproof, but usually about a third of them are. A third of them will get us to bulletproof status, meaning we've adjusted the put or lowered the cost basis to where we have now no risk on the trade. No trades are really no risk from the beginning, with the exception of conversions, but it doesn't make sense for us retail investors because, as you know, it's very commission heavy and it's capital intensive to buy the stock and sell the call and buy the put, but you might be looking at a guaranteed profit of only 0.2 or 0.3%. Well, how much monetary value, well, let me rephrase that. How many contracts do you need to get a monetary value that makes sense to cover the commissions cost? Now you might be in the thousands of shares and tens or 20 contracts in order to get a 0.3% return that monetarily actually makes sense after commissions. So everything has a little bit of risk. The idea is to control risk with the proper position sizing and the structures as well. Okay, but if you do think of a question later on, Chuck, thank you. Thank you for your questions. I'm glad you enjoyed the session. And of course, Sam, thank you for your questions and your comments and your somewhat assistance going through this. And thank you all, Bob, as well. Thank you for your questions. But if you think of anything over the weekend, send me an email to support@powerop.com or support@radioactivetrading.com. Remember, also call the office during market hours next week at 302-992-7971. And you can schedule one of those coaching sessions at any time. So feel free to do that as well. All right, ladies and gentlemen, take care. Have a fantastic weekend. We'll see you on the other side, and we'll see what the market has in store for us as we get into the last week of September of 2019. Wow, only 3 months left to go in 2019. Kind of scary. We'll see where it takes us. Take care, everyone. Good night.